the $95 billion promise. China pledges to buy billions of commodities from the U.S. as part of a Phase 1 trade deal from LNG to chicken. Winners and losers of IMO 2020. New shipping fuel rules are in effect, what products are soaring, and what refiner margins are getting crushed. And fixing the shipping industry. I sit down with Matthew Costello, CEO of Voyager, a startup dedicated to helping commodity producers and traders manage their business. I'm Alix. Welcome to Bloomberg Commodities Edge. 30 minutes focused on the companies, the physical assets, and the trading behind the hottest commodities with the smartest voices in the business. First, we kick it off with Spot On, our take on the big story. And today our spotlight is on the first phase of a U.S.-China trade deal. I asked Jeff Curry, head of commodities at Goldman Sachs, which commodity had the most upside.
The area where the big surprise is going to be livestock. They relaxed rules around hormones, which allows them to import more U.S. livestock. So beef and pork would be the ones with the real upside here.
China could also buy $52 billion worth of energy from the U.S. Here to help me break it down what that means is James West, analyst at Evercore ISI. Thanks for being here.
Of course, thanks for having me.
So your first blush to the U.S.-China trade deal when it comes to energy?
Sure. Well, it's a 4x increase in their energy buying from the U.S., so it's a big number. It's going to be all across a lot of commodities, a lot of energy commodities. We think the biggest winner is probably LNG, because that's been slow to develop in China with the U.S., and a lot of the U.S. liquefaction capacity is coming online, which is going to be good for those new facilities to sell into China.
So typically what we'd say is, oh, they're going to buy more commodities. We have to then make more of those commodities. Is that the case when it comes to, say, oil and gas?
The good news is we were already building liquefaction capacity, and so it was going to go to Asia no matter what. Now we know where it's going to go, most likely China.
We've also are talking a lot now that the year has started about what companies in the U.S. are doing in terms of their CapEx. Now there's going to be this demand pull from China, but we already are hitting record productions here in the U.S. Are companies going to be spending more if demand really picks up?
Not necessarily. Spending actually for 2020 is going to be down about 6% in the U.S. There's only 5 companies that are spending up. That's Exxon, Chevron, Pioneer, Diamondback, and Shell. So the rest of the industry is spending down, and we think that 6% actually could migrate down to down 10%. So the rig counts will be down, spending down, lots of overcapacity in the market. Going to be a tough year for oil services in North America.
In the U.S., staying with that for a second,
sure.
So that's sort of drilling, but what about completions? Like we have a lot of drilled but uncompleted wells.
Sure.
Like, are we going to see activity there, or is it already past us?
So there will be some activity in the DUC count, but the DUC count's already come down significantly, and so I don't see a big surge in DUC activity that's going to hold up utilization for pressure pumpers, for example. So completion companies will be under pressure for most of this year.
All right, that makes it sound like overseas is going to be the only bet for these oil services
Absolutely.
guys. For me, the news was CNOOC is going to be increasing their spending this year to like 20%. That's a national oil company in China. Who benefits? Who wins?
So clearly the large cap diversified. So Schlumberger, that's their backyard. Certainly Baker Hughes, 70% international, and Halliburton has an underappreciated international exposure. So international spending based on our work is going to be up probably mid-single digits, so 5% overall, and that's basically every market around the world. But offshore spending, where CNOOC spends, is going to be up probably 12 or 13%, so even better for the offshore markets.
And that, what about like Gulf of Mexico and sort of off of Brazil and Guyana, for
It's going
example?
to be, exactly. It'll be mostly the Golden Triangle, so Gulf of Mexico, West Africa, and then Latin America. And we see spending there up probably in the 14, 15%, a little bit more than Southeast Asia. But that spending should migrate towards the offshore drillers, so Valaris, Transocean, and then companies like Technip FMC, Ocean International, which recently upgraded, key players in the offshore markets.
I'm just so struck by talking to you in the massive reversal of the conversation.
Sure.
In like 6 to 8 months. I mean, I feel like just that long ago, offshore drillers did not stand a hope and a prayer of like getting any kind of stabilization, and how quickly that turned. Well, what's your interpretation of that?
It's the capital austerity being forced on the E&Ps in North America. We've had enough of this outspending of cash flow. Companies are demanding returns, and we're finding out the geology is not supportive of that. So while production will grow in the U.S. this year, we think the IEA and the IEA have forecasts that are way too high. We think they could be as high as 50% too high. So we see
50%
production
too high?
Yes, they're looking for over 1 million barrels of growth. We think you get 500,000 of black oil, maybe 200,000 a day, or sorry, 500,000, 200,000 a day of liquids, so call it 700 all in. So we think that number is going to migrate lower. It's going to disappoint to the downside for a lot of these producers in the U.S., and we have to spend somewhere. So we're going to spend internationally, we're going to spend abroad.
For the international oil services, do they have more levers to pull in terms of cost cutting, or are they actually going to find pricing power?
So they're actually going to find pricing power at this point. So cost cutting is done. We had 5 years of a downturn. It's been tough. So we've taken everything out. We're down to the bone at this point. So just seeing the volumes go through these facilities that are underutilized is going to show big incremental margins for big cat diversifieds.
James, love to catch up with you. Thank you so much. I really appreciate it. James West of Evercore ISI. And speaking of, as we had to break, the EIA did say U.S. production will only grow about 400,000 barrels of oil a day this year. That's the weakest growth in 2 years. CEO of Parsley Energy actually agreed.
I think that shale is not going to meet its growth forecast. It's very difficult. When we look at the same counties, we call it same store sales, the well productivity is actually already declining. Other basins, the Bakken, South Texas, they're already on a productivity decline. I think the EIA, the IEA are forecasting productivity increases for the Permian. If you flip that, it's going to be very difficult to meet the forecast over the coming years.
I'm Alix Steele, and this is Bloomberg Commodities Edge. Time now for the data dig, where we delve deep in some of the market trends. First up, you get oil inventory numbers down about 2.5 million barrels. In the report, though, interesting nuggets. Cushing actually within Pad 1 saw its first build in crude after 9 weeks of draws. And as I mentioned before, production overall did hit yet another high. And move over palladium. Who needs those prices over $2,700? This is a new precious metal stealing the spotlight. Rhodium. It rallied 12-fold in the past 4 years, far outperforming all major commodities. Rhodium, mainly used in cars, actually surged 31% already just this month, touching the highest level since 2008. And one more point I wanted to make on the U.S.-China trade deal. Will there actually be enough commodities to send? So this chart shows the yellow line, which is what China imports excluding the U.S., the blue bar, China imports from the U.S., and the orange bar, U.S. exports excluding China. And you can see here that China actually makes up 30 to 40% of things that we already send them, like frozen fish, mollusks, as well as crustaceans. So there's just not that much more room and things to sell them. Now we want to drill even deeper into a sea change in the shipping industry. Vessels have now had to burn fuel with less sulfur in it, and we are seeing the distortions in the market. For example, the cost of IMO-compliant marine fuel has actually skyrocketed in Singapore, while high sulfur fuel oil has actually underperformed. What's the ramification? Fernando Valle from Bloomberg Intelligence joins me now. I feel like it finally happened. We've been waiting it for so long, and the distortions are happening. What are you noticing?
I know, it's been 4 years at least since we've been talking about IMO 2020, and it's the end-all, be-all for refining. But it's kind of come with a little bit of a blip, particularly for ultra-low sulfur diesel. We're seeing the inventories build. You talked a little bit about it, the crude side, but in the U.S., you had such large builds in the refined product side, particularly diesel. Just the past 2 weeks, 13.5 million barrels, and it's really been a bit of a headwind for refiners. I think on the ultra-low sulfur fuel oil, you saw an expected increase because it's so difficult to create the blend stocks that these ships can run. And so that is the ready-made alternative. And that's why that price has gone that far up. And then on the high sulfur fuel oil, you just can't run. The scrubbers are not yet outfitted on all the different ships, and so there's a very low demand for it right now.
How long do all these distortions and then the margin pressure result in? Like, how long does it last?
I think it's not going to be very long from the outlook, just because there's been so much refined product in the market. You saw China, for example, issuing new export quotas. They put in major refining projects over the past 2 years that are flooding the markets. The U.S. itself, the demand growth has not been there. So we have plenty of product today to meet the demand. And even though the high sulfur fuel oil is going to have very low bids, we have alternatives. You can, for example, not produce as much gasoline and use some of that feedstock to use for maritime fuel as an alternative. So I don't think it will last more than 1 or 2 years.
What I also find interesting, we just showed the chart, which is VLCC and how much when you're running certain products, like how much more you actually have to spend. So with the scrubbers, for example, they're earning about 20,000 more a day than those without. Was that more or less than you expected? And I asked, does it cost so much money to put in the scrubbers? And there was always a question of like, how long do you get paid back? Is it worth it, et cetera?
It's more or less what we expected.
Okay.
The question is, how long will it last? And again, because we have so much diesel still, we thought there was going to be a problem because the crude slate in the world has gone very light, and that doesn't produce a lot of diesel. But we have a lot of, the demand has just not been there from other aspects, particularly with the trade disputes. So we have plenty of diesel today, and unless we get a major pickup in growth, I think we will be well supplied for the short term.
All right, Fernando, thank you very much. Bloomberg Intelligence, Fernando Valle. I bug him all the time about IMO. All right, now we want to get into the ring. It is Alcoa versus the aluminum market. The company is seeing another tough year with, quote, minimal free cash generation after reporting a fourth straight quarterly loss. For more, we're joined by Bloomberg's metal and mining reporter, Joe Doe. Joe, good to see you.
Good to see you.
Expected or unexpected?
We kind of expected a bad quarter out of these guys. We know that aluminum prices, there's not been a lot to talk about for the past year. We also know that they announced in November that they were going to scale down the company in terms of, consolidating management. And they announced that they wanted to do as much as $1 billion in sales of non-core assets. So they wanted to get more cash on the balance sheet, which this morning, if you saw all the notes, free cash flow came up in almost every note you saw, which is a worry that despite what they're doing, that there's still going to be worry about free cash flow.
Do they have any hope in finding support in the aluminum market? In that copper has found a bid. Maybe if that's a global growth signal, maybe aluminum should find a bid.
Listen, Alcoa is saying that they do expect more growth, demand growth out of aluminum from China. That's the biggest consumer. But they're not seeing a lot out of the United States. I mean, they straight up said, listen, we're just not seeing any green shoots right now. However, yesterday's trade deal gave them a little hope that if a phase 2 of the deal is done, maybe you will finally see that bid come back into the aluminum market. So yes, there is hope. And listen, the analysts have not been saying this is going to be a complete dog this year, but they have been saying, you got to be optimistic or a bit cautious with these guys and not just put all your eggs in one basket, which is Alcoa.
Are analysts able to sort of look at the company and give a time frame of like when they can expect a turn, like when it might get better, or is there just not the visibility they can see?
I think they're still kind of waiting to see what the next steps are going to be taken by the CEO, right? So they're looking to see how much do they actually sell in these non-core assets? How successful are they at getting towards that $1 billion? How good are they at actually managing the balance sheet? And when they're consolidating all management, how does that work out in the end as well? I mean, at the end of the day, they are still an aluminum producer. They're a commodity company, so they're at the whim.
Can't get away from that.
Exactly, they can't get away from that. But, this is going to be on Roy Harvey and his management, which so far, I think most investors feel like he's done a good job with what he has. But again, no CEO that is a commodity CEO can get away from the whims of the price of their commodity.
Totally fair. All right, Bloomberg's Joe Doe, thanks very much. Really appreciate it. And now for our note of the week, it's a twofer. First up, you got Larry Fink, head of BlackRock, making climate change front and center issue for the company. In a note this week, he said, quote, climate change has become a defining factor in the company's long-term prospects. Awareness is rapidly changing, and I believe we are on the edge of a fundamental reshaping of finance. Now, BlackRock said it will exit both debt and equity investments in thermal coal producers in its active portfolios. So then, on the flip side, you had another CEO, Joe Kaiser of Siemens, had to defend the company's decision to provide rail signaling for a controversial coal project in Australia. He said in a letter to investors on the website, while I do have a lot of empathy for environmental matters, I do need to balance different interests of different stakeholders. Had it been my own company, I may have acted differently. A fascinating 800-word letter you should definitely read. All right, well, coming up, revolutionizing maritime shipping and software with data analysis. We're going to talk to Matt Costello of Voyager coming up next on Bloomberg Commodities Edge. I'm Alix Steele. This is Bloomberg Commodities Edge. Time now for BNEF Brief, which gives in-depth research and analysis on clean energy, advanced transports, commodities, and emerging technologies. And today we're looking at the outlook for EVs. So the rush to electrify is now shifting to Europe from China this year, and that's according to a forecast from Bloomberg NEF. Joining me now from London is the man behind the report, Colin McCarricker. Colin, walk me through some of your findings.
Yeah, I mean, every year, Alex, we try and step back and think about what are we expecting in the year ahead. And on the top line for electric vehicles, we are expecting a record year of sales. We're expecting around 2.5 million passenger EVs sold around the world. That's about 20% growth. What's kind of interesting is that that's actually slowing down a little bit from the growth rates we've seen in previous years. This last year, 2019, was a little bit flat as well, and that's because we're in this phase of subsidies getting cut. It gets really expensive to subsidize the purchase of electric vehicles beyond the first sort of 3 to 5% of buyers. So we're starting to get into this rocky phase where subsidies are getting pulled out in some places. They still exist in others. So we are still expecting a record year, but probably relatively modest growth rates compared to some of them we've seen over the last 10.
On the other hand, you also found that you've seen battery costs finally really start to come down, and that's key to making the overall price cheaper, which is then key for real adoption. What'd you find?
Yeah, we've been tracking this stuff for a long time, as you know, going back all the way to 2010, and battery prices are down 87% since then, and it looks like they're going to keep falling. We're expecting another 13% drop from 2019 to 2020 levels. They're going to come in, we think, around $135 a kilowatt hour at the pack level. That's still a ways away from where you need for EVs to be fully upfront, cost competitive without subsidies, but it's certainly getting closer.
The other issue with adoption has been charging stations. You're not going to want to buy it if you're range phobic. Are we going to see the real build out this year?
Yeah, the numbers have been going up really fast as well on this one. So if you go back 2 years, 2018, there's around 600,000 public charging points installed. Last year, at the end of 2019, around 880,000. We think that jumps up to about 1.2 million this year. So the build out is well underway, and there are a lot of groups piling into this. There's everybody from oil and gas companies, utilities, pure play operators, telcos, and of course governments as well, pushing a lot of funding into this. So this part is growing quickly, but there are still big open questions around the optimal location of chargers, the speed of chargers, the right business model, the right way to charge consumers for it. So there's a lot of money being spent, a lot of groups piling in, but still some big questions to be answered.
Colin, thank you so much. Super appreciate it. Colin McCarricker of Bloomberg NEF. We turn now to Commodity in Chief, where we focus on one executive in the commodity world, and today it's Matthew Costello, the CEO of Voyager. First, a closer look at his company.
This is how energy trading works. Producers and traders go through thousands of transactions a year, banks pony up the short-term loans, and there's lots and lots of paperwork. Lots of companies want to change that. Like VAC, a digital platform that processes deals, a trade between two oil parties that agree on the same terms and conditions, then share their market data, which forms the backbone of the central ledger. And Comgo, a blockchain-based platform that provides the financing. And Data Gumbo, a platform for oil drillers and oil companies to execute and monitor contracts. And now there's Voyager. It wants to transform over 80% of global seaborne trade. Here's how it works. It's a cloud-based application where all parties work together at the same time, email and paperwork free. The goal is to manage and streamline workflow, which boosts efficiency and reduces risk. Some of their clients include Equinor, Invista, and Lighthouse Chartering, and it has big expansion plans.
I recently caught up with Matthew Costello and asked him how he's helping some of his customers.
One of our companies that we're working with is currently dealing with an issue around ETA variability. So they have a large production facility, and data and information is coming into them through different formats around vessel arrivals. Yet certain times of the year, they might have an average of a mean of 12-day delay with up to a 10-day standard deviation of when ships are going to arrive. So if you imagine you're trying to plan your inventory, your supply chain, your production, and you have some ships coming in 20 days late, some ships coming in 2 days early, and it's completely unpredictable. So with our application, we're able to actually collect that data centrally from across the organization, build machine learning algorithms to actually help them predict and optimize when those shipments are actually going to arrive. And that gives them far better reliability, allows them to reduce their working capital, safety stocks, results in a lot of reduced penalties, demurrage, and some of the support services that go along with that.
What are some other things that you can do that you've noticed that are popular that really work?
Yeah, so I think for a lot of companies, it's also just having all of their information in one place globally. So a lot of these companies have very large distributed teams. Everything is sitting in silos, in inboxes, spreadsheets, and by all of a sudden making that data available all in one place across global organization, it makes that information accessible to departments within the organization that never really had a really good maritime data set that represented all of their fleet activity.
What are you noticing trend-wise in terms of like what's being shipped, to who's doing the shipping, what areas short what? I mean, what are you seeing in the trend-wise?
Yeah, so especially out of the US, I think obviously the shale gas, or the shale boom has produced a huge amount of excess product in the market. So LNG is a really exciting place at the moment. So the LNG world has traditionally been, from a shipping point of view, very A to B. And now what we're starting to see as a lot more production comes online, people actually starting to trade a lot of this product in the market while the cargo is on the ships. Now what that means is that operationally you have a far higher demand for being able to manage the variability and the sudden changes in complexity, whereas normally it was very much just a bus service.
So because basically you're not looking at long-term supply agreements, you're looking at more like spot trading, et cetera, so they need more flexibility?
Yeah, so we do spot trading, but we can also manage the long-term contracts as well. All of them equally benefit from having better visibility and better control on the voyage.
What else, what other trends are you noticing?
Yeah, so I think on the technology side, what we are starting to see is companies gradually moving away from email. So if you look at the Fortune 500 right now, about 20% of them internally have already started to move internal communication away from email to things like Slack or Microsoft Teams. We think that this trend is going to continue within industry verticals, so shipping, transportation, and commodities, where companies are going to want to start having that same experience of app-based communication with everyone they deal with in their network. And what that is going to do is it's going to start bringing more and more people onto common vertically focused applications like Voyager to manage those communications.
Is there room for a lot of players in that, though?
Yeah, look, I think we'll start to see different platforms popping up servicing different areas of the market. So within the container transportation space, you have a lot of platforms coming up. You may see specific applications appear for specific verticals or commodities. So maybe within the dry cargo space or within the bulk carrier space or within the crude oil space.
That was my interview with Matthew Costello of Voyager. So are oil workers in the U.S. Permian losing faith in the good word? Well, there has been a slowdown in sales of a custom-made Bible for oil workers called God's Work for the Oil Patch, Fuel for the Soul. Last year, the Oilfield Christian Fellowship shipped about 16,000 Bibles across its chapters in the U.S., Canada, and Venezuela. That's down by about a third from its normal annual volume increase because of the downturn in the U.S., which has led to a reduction in things like jobs, hotel occupancy, and home sales. But fear not, doth fire and brimstone raineth down from the heavens anon. Some actually expect the U.S. oil patch slowdown will increase church attendance. Well, here's what's on my commodity radar for next week. Tuesday, you get earnings from Halliburton, Schlumberger setting the stage what Halliburton will say. Then later on in the week, you get earnings from Kinder Morgan as well as Baker Hughes. That wraps it up for Bloomberg Commodities Edge. Make sure to check us each Thursday at 1 p.m. New York time, 6 p.m. in London. This is Bloomberg.